The past 12 months have been good for Main Street Capital, easily outperforming the S&P 500. But to appreciate its ability to withstand a recession, we need to zoom out to its long-term history of total returns. And I don't think the last 12 months were just luck. I reviewed Main Street Capital back in April 2023. My conclusion was, great company, yield is a bit low for me, I'll wait for a market correction to buy some. Since then, Main delivered a record-breaking quarter, raised its regular dividend, issued another special dividend, and is now paying a higher yield than it was before. And let's not forget, Main sailed through the 2008 recession and the 2020 pandemic without a single dividend cut. So, in today's update, I'll bring you up to speed on what Main's been up to since the April review, why I'm now buying it, and why I think it can handle a recession better than its competition. I won't be explaining Main Street's business or BDCs today because that's already covered in the April review. Link to that video, which was shot in Khao Lak, Thailand, in the description. Since the April video, Main Street Capital has increased their regular dividend twice. It went from 22.5 cents per month to 23 cents in July, and in October, it's increasing from 23 cents to 23.5 cents. So the long-term trend for consistent dividend raises continues. As for the yield, that's up too. If Main didn't raise their dividend again for the next year, highly unlikely, then 23.5 cents times 12 months divided by the current price of $39.46 gives us a yield of just over 7.15%, up from 6.89% when I made the April video. What about the supplemental dividends? These are paid to investors when income is unusually high, and they're not included in the quoted yield on finance websites, so many investors aren't aware of them. Main has a history of paying a lot of supplemental dividends, so we won't be ignoring them. In the April video, I talked about the 17.5 cent supplemental dividend paid in March. Since then, they raised the supplemental dividend to 22.5 cents for the June distribution. Then they raised it again for a September payout of 27.5 cents. If we add the current regular dividend to the current supplemental dividend and annualize them, in other words, multiply them out to 12 months with no changes, the total yield has jumped from 8.68% back in April to 9.93% as of October 5th. A quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because now they pay for everything. When I find something interesting, I make a video. Every year in recent memory, the media warns us that a recession is coming. You can pick almost any year, but I googled 2019, recession definitely happening in 2019. Recession likely in 2022. Didn't happen. Everyone thinks a recession is coming in 2023. It's October and no recession yet. So I'm not saying a recession is coming. In fact, I'm saying there's way more talk about recessions than actual recessions. So to be clear, I'm not buying Main because I think there will be a recession. I'm buying it because I think it will provide solid returns regardless of whether we have a recession or not. Here are the reasons why I think Main Street Capital is recession ready. The CEO, Dwayne Hyzak, made $657,000 in salary in 2022. Not bad. More importantly, he made $1.3 million in dividends from Main because he holds about $18.5 million worth of stock, with the majority of his income and presumably net worth coming from Main Street stock, and most of the Main Street stock's value coming from its reputation for growing dividends. I think Dwayne's incentives are aligned with the investors. In other words, he's not thinking about his Christmas bonus. He's focused on growing income over the long term. Another thing I like about Dwayne is his tenure. He's been with the company for 21 years, so he was there during the ups and the downs. The president and chief investment officer, David Magdol, same scenario. $17.2 million worth of stock, and he's also been there for 21 years. In the review video, I explained how higher interest rates translate to higher profits for all BDCs, or most of them at least, including Main Street. However, if interest rates go too high, some borrowers won't be able to afford the payments and they'll default. Obviously, that would be bad. For this reason, we have to keep an eye on the non-accrual rate. That's the percentage of the loan portfolio that's more than 90 days behind on payments. That doesn't mean Main Street will lose their principal. They can still renegotiate the loan terms, or if the loan defaults, liquidate the collateral. However, it is an important indicator of potential future problems. The average non-accrual rate for BDCs is 1.5% according to Systematic Income Investing, and the median rate is 1.2% based on the fair value of the loans. In Q1 of 2022, Main Street's non-accrual rate was just 0.6%, far below the average. In Q2, it dropped down to 0.3%. I take this as a signal that Main Street is good at selecting borrowers who pay in full. The other metric I'm keeping an eye on is their ability to cover their dividend. The amount of income available to pay for dividends after expenses is called Distributable Net Investment Income, or DNII. Last quarter, it was $1.12 per share. Total regular dividends for the quarter came to just 67.5 cents. So that's why they paid a supplemental dividend. They had so much income left over. Even then, they still retained 22 cents a share for a rainy day. This chart shows how far the DNII is above the regular dividend. They have plenty of cushion to play with. Before we get to what's next for Main Street, many of the charts and information for this video came from Seeking Alpha, including the earnings call and various analysis articles. Of the 5 or 6 I read, my favorite one was written by Stephen Fiorillo. And that's not the first time I've recommended one of his articles. They're pretty good. It goes into way more detail than I can in a 10-minute video. Link in the description for a free trial, any current promotions, and that article by Stephen. And there's also a link down there for free stocks from Webull if you're opening a brokerage account. They are currently paying 5% on cash. I don't expect income to keep rising at this pace in Q3. The CEO mentioned during the Q2 earnings call that it was a really, really good quarter. I think he was implying don't expect profits to keep accelerating. Specifically, the CFO, Jesse Morris, explained that 8 cents per share came from dividends and loan prepayment fees that don't reoccur every quarter. And those dividends aren't our dividends. Those are dividends they receive from some of their borrowers because they take an equity position. The next supplemental dividend is obviously difficult to predict, but the CEO did say that they anticipate paying one in Q4. So that's a positive sign. If the Fed raises rates again, Main Street's profits will get yet another boost, but it seems like we're nearing the end of the hiking cycle and rates will stay higher for longer, as they keep saying in the media. I'm going to assume that the regular dividend will just keep rising as it's done since 2007, and the supplemental dividends will probably flatten out or shrink a bit over the coming year. We'll see. If we do get a recession, I expect that history will repeat itself. That is, the market freaks out and dumps BDC stocks, including Main Street. Then Main Street continues paying dividends as usual. Then the stock recovers and everything's back to normal. Main Street's price is more volatile than the S&P 500, so if that bothers you, don't get on the roller coaster. Speaking of pricing, is Main Street a good deal right now? No, Main Street is never a good deal. It's always overpriced. Every year there are articles and comments about Main being too expensive. Usually they're referring to the price-to-book ratio, which compares the price to the assets of the company. It is true that Main is expensive if you measure it that way. Here's a look at Main versus some of its competitors that I've reviewed on this channel in the past year. 1.44 times book value is expensive. Here are a couple of other things that are true. First of all, Main Street is almost always expensive. So if you wait for the price to book to come down, you could be waiting a decade or perhaps forever. Here's the price to book ratios for the past 10 years. The only time Main briefly dropped below 1 was during the pandemic. So in March 2020, those investors who were waiting for a good deal bought up loads of Main Street capital, right? Or did they? I'll admit, I didn't. Wish I had, but I didn't. So I think the investors who want a great deal will never end up owning Main, and as we saw earlier in the video, they missed out on incredible returns over the long term, as have I. I understand the psychological need to want a good price. In my review video, I said I'd buy some during the next market correction, and we're having one right now. Main delivered fantastic results in its Q2 earnings call on August 4th, which also happened to be the time when the S&P 500 decided to head down. So right now, Main is still expensive on a price-to-book ratio basis, but the dividend increases it delivered in August weren't rewarded with the kind of price appreciation you'd expect because the market has been in a slump. The other thing to note about the price-to-book ratio is that it doesn't account for dividend growth. Obviously, I'd rather own a stock that grows its dividend every year for 15 years than one that just stays flat. But the price-to-book ratio doesn't tell you whether the dividend's going up, down, or staying sideways. So it's relevant, but it's not the perfect measure of value. I'm loading up on Main Street Capital. I cap myself at 5% on any one stock or fund, so I'm starting at a 1% allocation, and then I plan to keep buying as new cash comes into my account until I reach 5%. Don't want to jinx it, but I kind of hope the price keeps falling for a little while. My overall thoughts on Main Street are that it's expensive because it's the highest quality BDC with a history of delivering consistent returns. Right now, the yield is a bit higher than it was in April because the dividends went up more than the price. So on that basis, it's slightly less expensive than it was back then. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you time. And yes, the Main Street review video is on that list, and I'll link it in the description too. That wraps it up for this update on Main Street Capital. More armchair income coming soon.